Hey everyone, welcome back to the channel. Today, we're gonna take another look at Roblox and talk about a pretty unique situation with them. A viewer recently pointed out I should actually be considering adding back their deferred revenue when looking at the company to see their kind of true performance and cash flow. For most companies, this isn't necessary as deferred revenue will be a relatively small portion of their total revenue and is negligible in the total picture, but for Roblox, they actually have deferred revenue that is roughly 50% of their current revenue. So quickly to hit on this, the main driver for this is the way Roblox recognizes revenue. When someone goes out and purchases Robux to be used on the platform, they don't actually recognize that revenue right away, but rather once the user redeems those credits in-game for avatars or experiences. So this leads to large amounts of deferred revenue as it's based on the player's habits of actually redeeming in-game credits. So this takes us to the DCF. We're going to use bookings as our top line when calculating EBITDA, and bookings will represent revenue plus the change in deferred revenue. Roblox reports their total bookings, and it's actually going to be pretty close to what I have. They have a few small adjustments they make that actually lowers the total. My guess is this is related to bad debt and possibly writing off a percentage of the deferred revenue, but I really didn't dig too deep into this as it's pretty immaterial to the total valuation. So when we take into account their deferred revenue, we see they've actually been cash flow positive the last 2 years, which is a completely different conclusion and story than what I got previously. In my first video, I went pretty deep into building out a revenue and expense forecast. You can find those videos here. But this time around, I'm going to take a bit more simplified approach to see if a refined forecast is actually worth the time and effort. The first thing we'll hit on is our forecast for total bookings. Now, if you read their 2021 Q4 press release or their February key metrics, they stated January revenue was up 66% and February revenue was up 63%, which sounds very exciting. But then they mentioned that total bookings is actually only up 3% in January and is down 3% in February. They're starting this year basically flat year over year, and the big difference seems to be player habits are just causing them to defer less revenue. The revenue growth is really just accounting, making revenue grow, but bookings is flat, is basically what I'm getting from this. So this took me down kind of a rabbit hole of how to forecast future bookings, and I decided to actually just take a simple approach and use analyst projections as a rough guideline. Based on the projections on Yahoo Finance, I used the average revenue for 2022, which was roughly $700 million increase versus 2021. So I've increased the total bookings by that amount compared to 2021 bookings, and I've continued this trend through my model. Analysts actually have the same 700 million incremental revenue as their projection for 2023 as well. So this method seems reasonable to me. The next big thing to hit on is COGS. We've layered in an additional piece, which is the change in cost of deferred revenue, as this is the cost actually associated with those deferred revenues. We're going to include this since we're including deferred revenue in our total bookings. From COGS, we can see this as a percentage of bookings has historically been around 25%, and I'll keep it in line with this historical projection. The reason I don't think they will have significant improvements here is the cost is coming mostly from the App Store and Google Play Store costs, which aren't going away as over 50% of their revenue comes from these two platforms, and that has only increased in recent years. The next big piece to tackle is developer exchange fees. I've held this flat to 2021 levels as well. I think this is the trickiest piece for them to control, as this is what developers get paid for making content on the platform. If you meaningfully adjust the revenue model, which I actually cover in another video, for developers, you may lose them and content will fall off, making your platform less attractive. If you're not familiar, the high-level TLDR is Roblox pays other developers a portion of what players spend in-game on the developers' creations, incentivizing them to create more content for Roblox on a commission basis. I have the remainder of operating costs scaling efficiently except for marketing, as I feel they will need to continue to ramp up and spend on marketing to provide meaningful growth. Once the world kind of returns to normal and people aren't at home all day in a post-COVID world, you're gonna need to lure people back to your platform and game. And I think that's only gonna happen through marketing. That's why I have those costs increasing. But based off all of these assumptions, we actually get a valuation between 18 and 19 billion, which is actually drastically higher than my first model, which is where I excluded deferred revenue, but it's still below their current market cap of roughly 25 billion. I think Roblox is a very interesting company, and depending on how their growth looks after COVID is over, it'll kind of determine if the company is fairly valued or not. If we continue to see lower or no booking growth throughout this year, then Roblox is actually going to be very overvalued currently. But if they can keep their player base and actually continue growing, it might be a fairly valued company at its current price. I think personally it's a hold. I wouldn't enter a position at the current price, but also wouldn't sell. I'd wait to see how they actually perform through kind of Q1 and Q2 and see if bookings has any growth. And see if maybe those habits from COVID will continue, and if they can keep that top line growth strong without the marketing cost, you could actually make an argument that it's a buy, but time will tell. As always, thanks for watching, and if you haven't already, please like and subscribe.